Good morning and welcome to the Commodities Institute podcast. I'm Emily Costa and today is Friday, January 30th, 2026. We've got one of those weeks where geopolitics, weather and market psychology all collide at once. Energy traders are recalculating Venezuela risk, metals investors are staring at eye-watering copper prices, agricultural markets are quietly shifting under the surface, and power grid operators are waving early warning flags about the future of winter demand. So let's take this step by step and make sense of what actually matters. Let's begin with oil, because the policy shift out of Washington is the kind that can ripple through markets for months. The United States has eased some sanctions on Venezuela's oil trade, allowing American companies to buy, sell, transport, store and refine Venezuelan crude. Production sanctions are still in place, so this is not a full reopening. Think of it as a controlled valve being turned, not a floodgate bursting open. The key detail here is that this authorization is designed specifically for US firms. Companies from countries like China and Russia remain excluded. In practical terms, this could mean more Venezuelan barrels flowing into legal commercial channels tied to American entities, while other players remain on the sidelines. It is a very targeted form of relief. Now, Venezuela's oil sector has been starved of investment and maintenance for years. Even if companies want to move quickly, rebuilding production is not like flipping on a light switch. Wells, pipelines, upgraders, ports, all of that takes time and money. There is talk of massive long-term investment potential, but in the near term, what we are really looking at is the smoother movement of existing barrels rather than a dramatic supply surge. Still, perception matters in oil markets. When traders see a sanctioned producer slowly re-entering the system, it changes the mental map of future supply. That can soften price expectations, especially in a market already worried about oversupply. And that brings us straight into the earnings spotlight for the major oil companies. Executives are facing questions not just about profits, but about geopolitical exposure. Chevron, which already has operations in Venezuela, is in a particularly interesting position. Analysts see potential upside if the environment stabilizes, but they are also cautious. Political risk, contract security, and long project timelines make it hard to assign clear value right now. Layer on top of that weaker crude prices in the last quarter, and you get a squeeze. Lower oil prices chip away at upstream earnings, even as natural gas prices have been stronger. So the story for big oil at the moment is a balancing act between near-term price pressure and longer-term opportunity in places that were previously off limits. Now let's pivot to metals, where copper has absolutely stolen the show. Copper prices just blasted through $14,000 per metric ton, hitting record territory in a move that looked less like a steady climb and more like a vertical launch. A lot of this has been driven by financial flows, speculators piling in, short sellers scrambling to cover positions, and momentum traders feeding off the surge. But here is where things get tricky. Copper is not gold. It is not just a store of value. It is a workhorse industrial metal. When prices rise too far, too fast, real-world buyers start stepping back. Manufacturers delay purchases, substitute where they can, or draw down inventories. In China, the world's largest consumer, signs of weaker physical demand are already showing up in pricing discounts in the spot market. So we have a classic tension, financial enthusiasm on one side, industrial reality on the other. Markets can stay disconnected from physical fundamentals for a while, but not forever. Volatility tends to increase when prices go parabolic because fewer participants are willing to take the other side of trades at those extremes. While we are on the theme of metals and strategic materials, there is also a notable agreement between the United States and El Salvador aimed at boosting investment in critical minerals. These are the materials used in everything from clean energy technologies to defense systems. The deal is about securing supply chains and encouraging US-linked development across the mining and processing chain. It is another sign that resource policy is increasingly tied to national security thinking. Now let's move into agriculture, where the shifts are quieter but just as important. In the oilseeds market, China has resumed buying Canadian canola after a period of trade friction. That complicates Australia's recent push to regain a foothold in the Chinese market. The interesting part is that Australia is not being pushed out entirely. Instead, we are seeing more of a price-driven competition between origins. When two major exporters are both viable, Chinese buyers can place spreads, and that tends to keep a lid on extreme price moves. Over in cocoa, Ivory Coast's regulator has stepped in to buy a large volume of beans from farmers after exporters pulled back. High fixed farm gate prices combined with softer global prices created a bottleneck where beans were not moving. The government stepping in is about social stability as much as market management. Cocoa is a livelihood crop for millions, and when the marketing chain stalls, the political pressure builds fast. Longer term, there are also forecasts pointing to potential global cocoa surpluses in coming seasons, as high prices encourage more planting outside the traditional West African heartland. If that materializes, we could see a very different price environment down the road compared with the recent era of tight supply and price spikes. Finally, let's talk about power, because this is one of those structural stories that does not grab headlines every day but has enormous implications. North American grid reliability officials are warning that the risk of winter power shortages is rising over the next decade. Electricity demand during the coldest months is growing quickly, partly because more heating systems are switching from fossil fuels to electricity. At the same time, a lot of new generation capacity is coming from solar, which naturally produces less during short, cloudy winter days. The result is tighter reserve margins in several key regions. In plain terms, the cushion between available supply and peak demand is shrinking. When extreme weather hits, deep freezes, winter storms, the system has less room for error. That means more price spikes, more stress on infrastructure, and a bigger role for backup fuels like natural gas and even fuel oil during crunch periods. So across all these markets, the common thread is transition under pressure. Energy systems are being reshaped by policy and geopolitics. Metals markets are being pulled between financial flows and real-world demand. Agriculture is adjusting to shifting trade routes and government intervention, and power grids are racing to keep up with electrification. These are not isolated stories. They are different pieces of the same global puzzle: how we produce, move, and consume the raw materials that keep modern economies running. And that is exactly why we watch Commodities, because they sit at the intersection of politics, technology, weather, and human behavior. If you found this episode valuable, be sure to subscribe, share, and leave a review.